Well, hello there. Welcome to Trusts 102. So in this lesson, you will be taught the different types of trusts that might exist. We won't be covering all of them, but the main types of trusts and what their potential uses might be for. So that you, by the end of this lesson, you will be able to spot the different types of trusts in use. You'll be able to understand why they're been used the way that they have been used and how to account for them accordingly. Okay, so first thing we're going to do in this lesson is to recap Trusts 101, which was what we did in the last lesson. So if you remember, we talked about the origins of the trust, that it was formed by common law in the United Kingdom, and that transferred to the US, Australia, and most likely the Philippines. I'm not a Philippines expert. The roles of the trust, we talked about the settlor, we talked about the trustee, we talked about the beneficiary, we also talked about the appointor, that was the evil brother Brett. They were the main roles, and we also discussed the basic vessel that was the trust and how that operated. We talked about the story where I had $100,000 that I wanted to give to you, but I didn't trust you, so I trusted someone else to dole that money out to you as they saw fit. And then my brother came along and got rid of that person because he was the appointor, and the appointor can hire and fire trustees, as you have learned. Okay, so in this lesson, Trusts 102, we're going to be talking about the different types of trusts that exist out there in Australia in particular. I'm not going to talk about other countries now, I'm going to talk about more specifics. So the first type of trust that you're likely to come across is called a discretionary trust. Discretionary, and it can also be called a family trust. Now, in its pure essence, it's a discretionary trust because the trustee has the full discretion as to what to give to the beneficiaries. Now, in my example before, we had where the $100,000 came into the trust, the trustee had full discretion as to how much money to give to you, the beneficiary. That's the operation of a discretionary trust. So the discretion refers to the trustee. So the trustee is the one who decides who gets what. It's also known as a family trust. And the reason it's known as a family trust is because their most common operation is to manage family wealth. So it's a good asset protection device, and I'll explain how that might work. But to put income into a trust and then distribute that income out at the discretion of the trustee to, say, family members that might have low tax rates, can be very tax beneficial, as well as providing asset protection as well. I'll explain the operation of a discretionary trust in relation to how transactions work through it in just a minute. But first of all, we'll talk about the other types of trusts that you might come across. The next kind of trust that we might commonly come across is called a fixed trust. Fixed trust. Hopefully you can see that on the whiteboard better than you could see the blue on the whiteboard. I'll just have a look. These can also be called unit trusts. And the way these work is completely different. So there's no discretion in relation to the trustee distributing to you instead of your sister or your brother or your mother or your cousin. In this case, the number of units that you own or that you control represent the amount of distribution that you'll get. So, I'll give you an example of how the fixed trust might work. So in my case, if I had $100,000, and the trustee decided to distribute that all to the beneficiaries. So if one beneficiary had, I'll say, 90 units, and the other beneficiary had 10 units, and that made up 100 units, all up, then this person would get 90,000 and this person would get 10,000. Now, under a discretionary or family trust, let's just say it's a discretionary trust, the trustee could elect to give this person, say, $6,000 and this person $94,000 if they so chose. But under a fixed trust, your entitlement to receive the proceeds of the trust, whether it's capital or income, is fixed, dependent upon the number of units that you hold. So that's a very important distinction. And I'll come back to the operation of fixed trusts and where they fit into the Australian business environment in general. Or I'll say the Australian investment environment, because that's really what trusts are all about. Okay. Good to see that I can rub off this writing. The next kind of trust that you might come across is called a hybrid trust. Now, a hybrid trust is simply a combination of a fixed trust and a discretionary trust. So what it usually does is say you have to distribute X amount in proportion to the number of units that people hold, but you also have a discretionary element, which means that you don't have to distribute, that you can distribute in, let's say, a tax beneficial way or some other way that's not aligning with the number of units that unit holders might have. Now, hybrid trusts, again, can be used in family situations. They might be used in some commercial situations, but they've really fallen out of favour because they're quite complicated in their operations, and they're not really that effective anymore either. The other type of trust that you might come across is called a blind trust. And a blind trust works a little differently to a discretionary or a fixed trust, in so much as it's very much acknowledged that the person the beneficial owner of an asset is giving that asset to a trustee to hold on their behalf, just to hold it on their behalf. So we find this in self-managed super funds, where property is involved, where there's a limited recourse borrowing arrangement, and don't worry about those terms just yet, all will become clear down the track, that there's a requirement to put that property in this, what's known as a blind trust, so that it's a separate entity. It doesn't appear in the books of the people that actually own it, because they don't own it for that moment, but this other person is holding it on their behalf. So there's a number of different commercial reasons that you'd want to use a blind trust apart from a self-managed super fund. Then you might get some fancy derivatives of trust. You might get things that are called, say, bloodline trusts, and those trusts might say that they get quite complicated. They're essentially discretionary trusts, but they say the trustee can only distribute income to someone who is of my blood. So in the example that we used, if it was a bloodline trust and I wanted to give you $100,000, unless you're one of my sons, my two sons, Reese and Kane, or my brother, my evil brother Brett, or his maybe nephews, you won't be able to get any income or capital distributed to you. Now, this is important. The reason that they use things like bloodline trust is because of marriages. So say I had $1 million I wanted to give my son, but I didn't like his girlfriend very much. I thought she was a bit of a gold digger. I didn't think that she was much chop. So I thought, and they eventually got married, and they were, going along their merry way. And then, of course, she cheats on him, and she ends up leaving him